It's an unusual time because, we're seeing the SEC proceed with this tactic of regulation by enforcement, which is not typical. Normally, it's regulation by regulations or by new
Right.
laws established first, and then they're enforced after fair notice is given to everyone about what the rules of the road will be. So this is an unusual time in the world of securities regulation in this new asset class. What's not unusual is a little bit of push and pull between competing agencies for jurisdiction. That's not unusual, but normally it happens behind the scenes. And the fact that it has spilled out publicly into the CFTC declaring what they think their jurisdiction is, and it is not a match for what the SEC is saying. This is a little unusual for it to be so public. Technically, commodities as defined under the Commodities Exchange Act are those things that trade derivatives, forward futures markets and things of that nature, which clearly that exists for Bitcoin. So it is a little bit of uncertainty that's spilled out into the public. And, I would say that some of the reason for that is the SEC in 2018 said Ethereum is not a security, or at least as it was trading by 2018 was no longer a security if it had been in when it was originally issued. And so that opened up a question of, well, this is the fundamental base layer for much of the innovation in blockchain. Who is going to regulate it? And so the CFTC has stepped up and said, yeah, this looks like a commodity to us, and we are, looking forward to regulating Ethereum. So, and then, just last month, Paul, the SEC tried to walk back Hickman's statement about Ethereum. And in a case out in San Diego last month, they said, with respect to the question of is Ethereum and the Ethereum network issued as an investment contract, we haven't made up our mind yet.
Right.
Which is kind of humorous since Ethereum has been around for 8 years now. And Gary Gensler has repeatedly said it is clear as a bell to all market participants what qualifies as a security under the Howey test of 1946 that dealt with orange grows. And so a little bit of inconsistency there and more uncertainty introduced very recently into this analysis. If we have a scenario where, let's take Coinbase, for instance, you can trade Bitcoin and Ethereum, which are arguably commodities, and then they trade hundreds of other tokens that may or may not be securities. So this is a really different kind of proposition, whereas the New York Stock Exchange and the NASDAQ, they trade equities, which are securities. Simple enough, SEC regulation. Here, you've got commodities, possibly securities, and then this third category of other digital assets. So this is a great example of where legislation should exist saying, okay, we're going to resolve this once and for all. This regulator is going to have responsibility for crypto exchanges. And your question was, can the CFTC do it? The answer is yes, absolutely, they can do it. They regulate exchanges in really complex products, derivatives, and they do surveillance of market for manipulation and anti-money laundering and all of those things. So yes, they could do it. Best answer is a comprehensive statute that sorts all of this out rather than kind of piecemeal legislation, because what you do in one area impacts another area. What you do in the spot market definitely impacts the derivatives market. What you do with stable coins impacts, questions around banking, and should bank regulation come into, the issuance and the security of stable coins. And what I would say is it's really, really unfortunate that the United States of America has fallen behind. And, all you have to do is look to Europe. And I don't often say that, but the European Union is about to roll out and phase in a comprehensive framework called the Markets in Crypto Assets Act. And it's going to deal with what is a utility. It's going to have definitions that people are really struggling with. What qualifies as a utility token? What is a stable coin? What is the transparency requirements? How do exchanges work? How do they protect the custody of assets of customers? How are they transparent? How do they not engage in proprietary trading, which is really interesting because that was a problem with FTX and Alameda trading against order flow from FTX. And so what I would say is, it can be done. There are 27 countries in the EU. They all agreed. It's really remarkable that we can't do anything like that here in the United States, when traditionally, when it comes to financial markets regulation, we were always out front and established the template for many others to follow. First of all, we have divided government here, and the prospects of getting legislation through are not great. But one way that it might happen is if the SEC and the CFTC jointly formed a working group to decide who we believe should regulate which assets and which markets, and then jointly approach the Congress with a proposal that would have a chance. Then we wouldn't have this, competing appearances where, hey, I think I should have a jurisdiction.
This seems just like it's going to delay things constantly.
Yes, indeed.
Okay, so
by the way, we've seen this once before. There's a great example of what happened in the 90s. Was a disruptive technology appeared on the scene. This technology today we're dealing with is blockchain and digital assets with ledgers on the blockchain. Well, back then was the internet, and what happened was people started using the internet and bulletin boards, for lack of a better term, on the internet to trade stocks. These were registered securities, regular stocks, and IBM or whatever. They weren't unregistered securities. And what happened was the New York Stock Exchange and the NASDAQ said, hey, wait a minute, they can't do that. And what happened was, because they need to register as formal securities exchanges, and that is a huge, huge undertaking. Mm-hmm. So the chairman of the SEC, Arthur Levitt, said, what we're going to do is we're going to take a pause here and study this new technology that is really transforming a lot of things, including financial markets. We're going to talk to these disruptors and get their input. We're going to talk to the incumbents and get their input. And most importantly, we're going to talk to investors and get their input. And the result of that, Paul, was a 3-year process that resulted in something called Reg ATS, Alternative Trading System. And because Arthur took the time to get it right, it stood the test of time. Reg ATS is in effect today, 25 years later, and entities are registering every year. My law firm used to help companies register as ATSs under that regulation passed 25 years ago because the SEC under Arthur Levitt recognized that the internet is changing the game. And quite frankly, I think we're seeing that again. And this enforcement, this regulation by enforcement is the wrong approach when something like this
you would
happens.
think they would have learned from these kinds of scenarios because we've got a great blueprint ahead of us, and you're right.